Back to the MD Investor channel, the channel where we're talking about personal finance and setting goals and achieving goals, taking responsibility for our personal finance by increasing our financial intelligence, definitely teaching our children. Why? So we can break the cycle of generational poverty. Welcome back to a new video. Before we get into the new video, guys, definitely hit the subscription button so you'll be notified when new content comes out. Let your friends and family know that there's a place that where we can go to and learn about this information that we were never taught. Critical information, especially in this day and age. Absolutely. Let's get into it, guys. Quick short video today about the Form 1099 DIV. You see the form right here. What is the 1099 DIV? 1099 DIV is basically a form that you will get from your financial institution, whether it's from TD Ameritrade or E-Trade or Schwab, or even from your transfer agent, Computershare, or any of the other transfer agents. So basically, whenever you get dividends from a company of at least, of more than $10, you'll get a form like this. Not only do you get a form like this, but you know who else will get a form like this? The IRS. They also get a form like this. Why? To keep us honest. So here's the 2020 1099 DIV form. On the left side, you got some basic demographics of the payer. So this would be the financial institution, transfer agent, or the brokerage house that's providing the information. So you would have maybe TD Ameritrade here or whatever, or the transfer agent Computershare, have their address, phone number, their payer ID. The payer ID of the payer. So the employee ID number of TD Ameritrade or Computershare. The recipient's ID, that'd be you. So your social security number would be here. Your name, your address, all that basic demographic, and your account number, okay? There's a lot of boxes here, but only a couple that we're really going to focus on. 1A, total ordinary dividend. We've done videos about the difference between ordinary and qualified dividends, so we're not going to belabor the point. The summary statement is that qualified dividends are taxed at the long-term capital gains rate, anywhere from 0 to 20%. Ordinary dividends are taxed at your marginal tax rate. So it could be anywhere from 10 all the way up to like 30, I think 39%. Okay, so total ordinary dividends. If you got $1,000 in dividend from Johnson & Johnson for 2019, it would be here. Out of this total ordinary dividends, 1B says how much of that is qualified. So out of that $1,000 in dividends from Johnson & Johnson, if 100% or all of it is qualified, it'd be $1,000 listed here as well. Obviously, if $1,000 is $1,000 is ordinary and only half or 500 was qualified, then it'd be a 500 here. You'll see why that'll make a difference. Obviously, the more qualified it is, the better, because you get a more preferential or favorable tax treatment. The next piece of information that we'll probably take a look at is box 4, federal income tax withheld. So if income tax has been withheld from your dividends, it'll be documented here. And that's important to know, right? Because if you've already paid taxes on some of these dividends, then there's no need to pay it again. Okay. Section 199A is basically something called a qualified business income. If you're making dividends on that, it'll be documented here. This dividend would be a portion of this. 1A is the total, and then 1B would be a portion of this. Obviously, it could be 100% depending. Box 5, the Section 199A dividend would be qualified business income dividend that's, I think, is subject to about 20% tax rate. And that's the basic information, guys. It's not a complex form. It's very short, and it gives the basic information. Let me just add this. There are some states that tax the dividends. So you see here in 13, 14, and 15, because they'll probably also be aware of this too, and and that's why they over in your demographics, what state you live in, they'll probably send a copy to your state as well. Okay, so if you live in a state that's going to tax your dividend, that's um, going to be important. So we'll probably do other videos about like certain states that tax dividend and certain states that don't. So this will be financially intelligent. Okay, you would get one of the 1099 DIV per company. So you'll get one for McDonald's. If you own stock in McDonald's, you get a dividend. You get another one for Home Depot, and so on and so forth. Let's switch over here to your 1040. Now, normally, guys, when we fill out the 1040, right, where it says wages, salaries, tips, it'll go on line 1, right, from your W-2. That's your job gives you a W-2, and also to the IRS, so they know how much money they paid you. But if you're not making your income from working, right, but you're making from qualified dividends, that's where the information will go that you made from your 1099 DIV to go here and qualified dividends here in 3A. You see 3B, ordinary dividends, attach Schedule B if required. That'd be your dividends that are not qualified but ordinary. So, for example, your dividends from a REIT, Real Estate Investment Trust. And we're assuming that it's not in a Roth IRA, because if it's in a Roth IRA, then the whole thing would be tax free. So, just a quick video, guys, about this 1099 DIV form that you'll be getting if you have received at least $10 in dividend. If you receive less than $10, then you won't get one. You get one, the IRS gets a copy, and it's basically a simple form, guys. Demographics for the payer, demographics for you, the total dividends, how much of that is qualified, if there's anything that's been withheld, federal tax that's been withheld, the 199 section 199A dividends, which is the qualified business income dividend that is subject to 20% tax rate. And let me add this before we close up. It doesn't matter if you are in a dividend reinvestment plan, because sometimes people are in a DRIP, a dividend reinvestment plan. They don't get the cash; the dividend is reinvested. So you may not have, say, got the cash to your account. You will still get a copy, because as far as the IRS is concerned, you got dividends from these companies, which is true. You just use it to buy more shares of stock, but we still want to be paid our dividend. So, and we've seen 13, 14, and 15 that the state that you live in may get a copy as well. So we'll also do other content along the lines of this. So we'll be a little more intelligent, okay? So you don't want to be caught surprised when, New York State is looking to tax me. I wish I would have known that, just so we'll know. So we'll do other videos about some of the states that tax dividend and some that do not. So just remember, guys, continue to like, subscribe, hit the notification bell so you'll be notified when new content comes out. And we're doing it, guys, one video at a time, trying to increase our financial intelligence, teaching our children so we can break the cycle of generational poverty. Continue to command your money to grow, and we will see you on the next one. Take care, guys.